Just as electricity transformed industry a century ago, capital-intensive megatrends are rewiring global markets today. AI, climate adaptation, and supply chain security aren't just buzzwords, they're reshaping how capital flows across borders and sectors. So why is this evolution requiring investors to reconsider portfolio allocations that have worked for years, and why waiting for perfect clarity might mean missing the opportunity? We're going to chat about all of that and more right now on UBS Trending. Hi, everyone, and thank you so much for joining me for another episode of UBS Trending. I'm Anthony Pastore, your host for the next few minutes, and my guest in the studio with me is Lauren Goodwin, economist and chief market strategist from our great partners at New York Life Investments. Lauren, wonderful to have you back here with me in the studio. Good to see you.
Oh, so good to see you as well.
We did a lot of chatting right before we started filming today, and there's a lot that I want to get to with you, but something that we kind of really teased in the intro is that many investors are kind of navigating the last couple of weeks of a lot of volatility and a lot of uncertainty, and something that you've been talking about is a little bit of a rebalance of portfolios. Talk about that with us, because I think that's a really interesting way to get our conversation started.
Oh, absolutely. I mean, look, these last few weeks, even couple of months, have been pretty challenging for investors. And one of the things that I think is interesting to note about market volatility is that typically when you see a 8-9% drawdown like we've seen, it's the result of real scares in the economy. And this time, it's actually a step earlier in the process. It's policy uncertainty that's driving volatility. And I expect that volatility will stay with us until that policy uncertainty clears. And I'd be curious if you do, but I don't have a clear sense of when that's going to happen. And what I see investors doing as a result of that is sitting tight, staying put, saying, look, you know, if anything, I'll pull back a little bit, might allocate a little more to cash, but I'm not going to get started in this market until I have a sense of where it's going. And what I'd like to make the case for with our clients, with investors generally, is that actually, even though there's a lot of uncertainty around things like trade, as an example, I think there's a pretty clear through line of the transition the global economy is making, and there are some elements of that can be investable that I believe investors can rely on. Yeah. And that's why the way you teed it up was perfect. If we wait to be so certain of these trends, they may have passed us by. And so where can investors be strategic, be smart about allocating, acknowledging that it is an uncertain time?
Right. And look, you and I have been in the business long enough to know there's no such thing as complete certainty, but there are different levels of uncertainty. So maybe the last 2 years, we saw the S&P 500 on the equity side up 20 to 25%. 2 years in a row. This year is not the same picture, so maybe there's more uncertainty, and I think also from the policy perspective, as you just said, certainly is making people try to guess what's going to happen next. And to answer your question, nobody has a clue what's going to happen next. And so that's where experts like you and our experts in CIO come into play. Obviously, put that money to work. There are definitely parts of the intermediate part of the curve, and there's opportunities within being selective. You can find places to put your money to work. But let's go back to those themes for a second, because artificial intelligence, those types of megatrends, security, we're talking about, you know, as you said, this sort of look at the, you know, supply chain security, things like that, how they're already reshaping the way people are looking economically around the globe. What are you seeing when you look at that data?
Yeah, so there's three major trends I see shaping the markets today. The first one is cyclical, which we can dive into, but it's that interest rates globally are moving lower. There's concern that inflation, especially in the US, might push rates higher eventually, but at least for the rest of this year, I think the bar for interest rates moving higher is actually quite high. And so in that environment, with rates moving lower without recession, that's a credit creation opportunity. And we're seeing that, I think, interestingly, not only in the US, but also in places like Europe and Canada, where that interest rate cutting cycle has been faster. And so there's a geographic diversification opportunity that's been opening there. With respect to the sort of global megatrends, I mentioned trade earlier. You know, Europe spending on defense is another. These are dynamics that are coming up in the market now because of policy proposals from the Trump administration. But changes related to these megatrends are not just about that. There's a long history and some really prime recent examples making these trends towards artificial intelligence, supply chain reglobalization, electrification, or adapting to climate change.
Right.
These things are happening. Even if I knew exactly the way that tariffs would run, even if tariffs went away, these things would be happening. And so it creates an opportunity for investors. The third sort of theme that we identify being that private markets access is democratizing. And so putting these things together, market structure's changing. Again, I think the allocation opportunities that investors have looking forward 5 years are quite different from what they've had in the last 15 years.
Taking those themes and those megatrends, where are the best opportunities in the market now? I mean, we obviously look at the Mag 7, and there's been a little bit of volatility in there as well. But everybody's talking AI all the time. But there is so much else out there. Where are you seeing some of the best opportunities given those megatrends?
Well, first of all, with respect to AI specifically, and really all of the global megatrends we're seeing, they're quite capital intensive.
Yes.
That's a different type of investment from the last 10, 15 years where winners have been in the tech space, but it's intellectual capital, right? Now we're looking at not just the foundational layer of artificial intelligence, the opportunity to invest in the chips, the data structures, the algorithms, but the electricity and the data centers that fuel them, the real estate where it's housed, and we haven't even gotten to the application layer of this technology. And so we see a broadening opportunity set for investors specific to this artificial intelligence space that it's been identified for the market. It's not a new idea, but it's compelling, I think it's durable, and there are opportunities in this space also that are inflation aware. So you think about your servicers of the electric grid. These are services that pass on higher cost to consumers where they arise, and so equities in that space can build some resilience both to some of the inflation concern that we're seeing in the market, but also to these long-term themes.
I do want to ask you, though, because the word stagflation has been coming up quite a lot with a lot of people around these halls, and I'm sure in your world as well. And by definition, it's higher inflation with slower growth. And the reason why it's coming up is because, as you pointed out earlier when we were talking, the Fed did indicate that they were looking at potentially slower growth. Is stagflation something that investors should be thinking about as they think about what the rest of the year looks like for their portfolios?
So directionally, yes. Our expectation coming into the year was that we would see slower growth over the course of the year, in part because we did a lot of research on what happens when a central bank starts cutting rates without recession. And what we found was that the cycle extends, but it doesn't reaccelerate. If you add uncertainty, then it's more likely that you would see a slowdown. And so we're aligned with the Fed's expectations for below 2% growth this year. We're also aligned with the idea that inflation was already potentially firming, and policy risk there too may push inflation higher. So directionally, I think these risks make a lot of sense for investors. Where I'd caution or just add is that typically when we think about stagflation and how to allocate, you're looking at tips, commodities, your asset classes that tend to perform well in moments of inflation surprise. And I don't know that we'd be surprised by modestly higher inflation at this point. And so and with respect to growth, though growth is slowing, it's still quite constructive in the United States and even in places like Europe relative to their long-term trend. And so I don't think it's the right time for investors yet to be hard positioning for stagflation, because there are opportunities, for example, in the credit space where we're not looking at recession, where credit quality is very strong, where balance sheets are fortress level. And so positioning hard for stagflation might cause them to miss out.
Right. And obviously one of the things we recommend, and our advisors recommend in our Chief Investment Office, is thinking about long-term investing and obviously having a diversified portfolio. So within the context of what you were just describing, having those instruments in there to protect against inflation and things like that. I mean, most portfolios that are well constructed will be able to manage any level of stagflation or hopefully not, but a recession, even working with a professional. Last question, because it's always a big topic, is the private market side of the story. We have at CIO, yes, we believe in a traditional portfolio, but now we think a traditional portfolio should include an allocation to privates. Talk about that.
Well, one of the really important transitions we're seeing in the capital markets is what I would call a second renaissance in the private markets.
Yeah, for sure.
The first came in the lower for longer interest rate period, where institutional investors who maybe couldn't benefit from the run up in growth equity had a 7% or 8% return that they needed to hit, and they just couldn't do it. So they had to get more comfortable with these less liquid parts of the market and harvest what we call in the industry an illiquidity premium, that money you earn by locking it away for longer. And what we're seeing now is a little bit different, a second renaissance, where everyday investors like you and I are looking at the world and saying, 20 years ago, I guess 25 years ago now, in 2000, there were 7,000 public companies. Now there's less than 5,000. And there were maybe 2,000 private companies. Now there's more than 10,000 financed in private markets. And so when you're just looking at your diversification opportunities, your ability to invest in Main Street, some of the things that make the U.S. economy in particular so unique, though I would say there are elements of the European market that are true for this as well. That doesn't seem quite fair, right? So we've seen a real uptick in demand for access to the private markets, and that's bringing more cash into the space, creating more competition, and more product availability for average investors. And for those that are looking for those diversification benefits, we do think that makes sense. The couple of things I would look out for is, first of all, are you getting the diversification benefit you're really looking for? And so if, for example, you're focused in the large and mega part of the private markets, that might look more similar to your large cap equity exposure should you look to the middle market or lower middle market. As with any investment, where can you build resilience? Where are the parts of the market where quality is still a function? And frankly, I'd pull that right back to the public markets, where riskier spaces, historically like the high yield space, if you're finding quality in a resilient economy like we're seeing, that's a compelling investment argument. And so many of the same elements of be sure you know what you're buying, be sure you know how long you need to hold it, be sure you know if you're getting that diversification benefit you want, that's what you're looking for in the private markets as well.
Right, absolutely. Lauren, thank you so much. Great conversation. I wish we had more time, but good to see you, and thanks for your insights. Come back soon.
Thanks for having me.
Great, thank you again, Lauren Goodwin from New York Life Investments. Thank you all for joining us. There's more information on our website, ubs.com/views, coming out of our great partners like New York Life, as well as our own Chief Investment Office. Plus, you can follow UBS on all of our social media platforms that we're a part of, LinkedIn, Facebook, and follow UBS Studios on Instagram. Our name there is @UBS Trending, so take a look for that. And as always, if you have questions about anything that Lauren and I spoke about today, make sure you're talking to your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day, and remember to keep your eyes on what's trending. See you soon, everybody.